Hey everyone, welcome back to Corporate Decoder, the place where we unravel the financial mysteries that shape our world. Get ready for a dive into FedEx's latest moves that might just surprise you. Before we dive in, if you are new here, hit that subscribe button and ring the bell so you don't miss our deep dives into corporate filings. And for those who want to continue the conversation and get even more exclusive insights, join our Discord community. The link is in the description below. Today we are looking at a company many of us rely on for getting things from here to there, FedEx. This report, a Form 8K, is like a special announcement for big news that happens between their regular financial reports. So what is the big news here? It seems FedEx is getting ready to spin off a major piece of its business, FedEx Freight. And to make that happen, they've set up some new borrowing arrangements or credit facilities for this soon-to-be independent freight company. Think of it like getting a new piggy bank ready before a kid moves out. So FedEx Freight, which is a part of FedEx right now but will soon be on its own, has locked in not one but two credit facilities. The first is a revolving credit facility, which is like a flexible credit card for a whopping $1.2 billion. This means FedEx Freight can borrow, repay, and borrow again up to that amount. It is designed to cover their general corporate needs, including any future acquisitions, and also to help with the costs associated with this whole spin-off process. Then there is the second one, a delayed draw term loan facility for $600 million. This is more like a loan you take out for a specific purpose and you can draw down the money over time. This particular loan is specifically earmarked to help fund the spin-off itself. Part of it will go towards paying FedEx a cash distribution related to the spin-off, and the rest will cover other costs and fees tied to separating the freight business. Now, let's talk about the cost of this money. The interest rates on these loans are tied to how FedEx Freight is doing financially, specifically its credit rating. They have options for either a base rate or a benchmark rate, which is currently based on a SOFR rate. The interest rates will range from a low of 0.00% to a high of 1.75%, depending on the type of borrowing and FedEx Freight's creditworthiness. On top of interest, there are also fees like commitment fees for unused money and other administrative costs. These fees can add up, ranging from 0.09% to 0.25% annually on the unused portion of the credit. These credit lines aren't going to be available forever. For the revolving credit facility, the commitments will end on the 31st of August 2026 unless the spin-off happens sooner. The term loan facility has a few more termination points, including the date the loan is fully drawn or by the 31st of August 2026, whichever comes first. It is all a bit of a race against time to get this separation done. Now, beyond the financial arrangements, there is a leadership change to note. Stephen E. Gorman has announced he is stepping down from FedEx's board of directors. He is doing this because he's going to join the board of the new FedEx Freight company once the spin-off is complete. This sounds like a planned transition, with no mention of any disagreements, which is usually a good sign. He is essentially moving from overseeing the whole parent company to focusing on the newly independent freight division. It is important to note that this report mentions exhibits like the actual credit agreements. However, some of the more detailed schedules or attachments have been left out because they're not considered material or publicly disclosed. FedEx is essentially saying, we've got the details, but we're not sharing every single comma and period with the public unless the CSE specifically asks for it. This is pretty standard practice, but it means we don't get the full nitty-gritty picture of every single term and condition. Now, let's look at the bigger picture here. This spin-off and the new credit facilities signal a significant strategic shift for FedEx by separating the freight business. FedEx is aiming to unlock value and allow each business to focus more effectively on its core operations. The freight business often has different economic cycles and operational needs compared to the express delivery side, so this could lead to better efficiency and growth for both entities. However, there are always risks. The success of the spin off hinges on a lot of factors, including market conditions, regulatory approvals, and the ability of FedEx Freight to stand on its own 2 feet financially. The large credit facilities, while providing necessary capital, also mean that FedEx Freight will start its independent journey with a considerable amount of debt. Investors will be watching closely to see how quickly FedEx Freight can manage this debt and generate enough profit to satisfy its lenders and shareholders. One thing that is interesting here is the timing. The report is dated the 16th of January 2026, but references an event as early as the 12th of January 2026. This kind of tight schedule indicates that these actions are happening very quickly, likely in anticipation of the spin-off, which seems to be very near. The credit facilities are set up to be fully operational by the 15th of January 2026, meaning the new freight company will have its financial backbone in place right as it is about to launch. Looking at the registered securities, we see FedEx's common stock, which is traded under the ticker FDX on the New York Stock Exchange. They also list various notes, like the 1.625% notes due 2027, and other notes with different interest rates and maturity dates. This shows a diversified capital structure for the parent company, which will likely change as the freight business is separated. The new freight entity will presumably issue its own debt and equity instruments. The core financial story here isn't about current profits or losses for FedEx itself, but rather the strategic financing for a major restructuring. It is about setting up the new FedEx Freight for success by giving it access to substantial capital. We're not getting into the nitty-gritty of revenue and profit numbers for FedEx Corporation in this particular filing, but rather focusing on the significant financial arrangements being made to facilitate the separation. The big takeaway is FedEx is making a bold move to reshape its business. Overall, FedEx is making a decisive move to restructure its operations. The spin off of FedEx Freight and the establishment of significant credit facilities for the new entity are clear indicators of a strategy focused on specialization and potentially unlocking greater value. The key risks revolve around the execution of the spin off and the financial health and debt management of the newly independent FedEx Freight. If managed well, this could lead to a more agile and profitable FedEx and a stronger, more focused FedEx Freight. But if not, it could introduce new challenges. The company's direction is clearly towards creating more focused business units, which, in theory, should lead to better performance, but execution is everything. Alright, that is our breakdown of this FedEx 8K filing. What is your take on this spin-off and what it means for FedEx and the freight industry? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and don't forget to subscribe for more deep dives into the corporate world. Also, a huge shout out to everyone already in our Discord community. Keep those conversations going. If you haven't joined yet, the link is in the description. Thanks for watching, and we'll see you in the next decode.